21 past 6. This next segment is brought to you by Fisher Funds. August was a month of two halves when it came to share market performance around the world, and for some of us, we would have noticed the effect it had on our KiwiSaver account. Fisher Funds Chief Investment Strategist Mark Brighouse joins us to give insights into what was happening and the lessons learned. Morning, Mark.
Yeah.
Okay, so I talked about August. What happened in August? What was going on?
If you're following the financial headlines in August, you would have been pretty confused, because even though from the beginning of August to the end of August there wasn't much change, there was a big decline at the beginning and then a big rebound. And the decline in share markets and KiwiSaver balances was triggered by a rise in the unemployment rate in the United States and news of an interest rate increase in Japan. Japan increased their interest rates from 0.1% to 0.25%, and that was enough to trigger some sharp declines. The US share market went down by the most it has in the last couple of years, and the Japanese share market went down by the most it has since 1987.
Gosh, everything was bouncing all over the place. So as you say, in August, it kind of was, you know, there was that dip, but then it rebounded. So what happened there? Yeah,
there are two things that drove that recovery. It was more and more central bankers talking about how there might be time for interest rate cuts. We saw interest rate cut in New Zealand, and news of a US inflation number that showed that inflation is increasingly under control. So the last 3 years of battling high inflation have been succeeding, and inflation has come down, which is good news for the markets.
Okay, so, you know, if you're looking at your KiwiSaver account, or if you're an investor and you're looking at what happened in August, you know, things starting off okay, dropping off and then rebounding, and as you say, by the end of it, it looked like nothing had actually happened. But if you were monitoring that month, you know, what is it that we have to remember when it comes to volatility, you know, in the market?
I think you have to remember that volatility is normal, that share markets go up and down, especially over the short term. And the media, the financial media, is very good at giving you all the short-term news. It's a bit like the distinction between the weather and the seasons, right? Every day the news media tells us what today's weather conditions are like. You can see it in the corner of your screen, the temperatures up and down the motu. And the financial news media tells you a lot every day about current conditions, but not so much about the longer term. So, and the thing to remember, even if you're looking at today's temperatures, is last week was the first week of spring. So investment's a bit like that as well.
Yeah, okay. Well, just to wrap up then, because we are talking about volatility, how important is it then to diversify your portfolio?
Yeah, well, the rationale behind diversification is some of the shares in your portfolio will be going up at the same time as others are going down. Yep. So you can get the good long-term returns from share markets with less volatility from day to day if you own a broad range of shares, because any time there will be some that are offsetting others. They won't do it perfectly, it won't be a completely smooth ride, but that'll reduce the overall risk in your KiwiSaver scheme by quite a lot.
Yeah, you want to be... Usually I just don't look at it because I know that it goes up and down all the time. Hey, Mark, so good to have you on the program. Thank you for joining us this morning. Mark Brighouse, Chief Investment Strategist from Fisher Funds. Thank you.
Me, Tony Meyer, stay with us.